We're now talking about capital raising and the types of capital that companies in the fintech space can use to raise capital, and hoping for some insights from our panelists on their experience about the smartest type of capital that can be raised. I'll first of all start by asking each of our panelists to introduce themselves.
So Graham Olive from Oak North. Oak North is the bank for entrepreneurs. It was founded by two entrepreneurs who had previously set up and ran an outsourced research business and sold it for a final exit valuation of $700 million. And as you do, they decided to set up a bank. They identified that the UK market was very poorly supplied, with an oligopoly, with out-of-date technology and historic litigation and capital problems. So they decided to set up from scratch a bank with state-of-the-art technology. We were the first bank to have all our systems migrated onto the cloud. We have a very integrated deposit collection model, 3 clicks online and your deposit is placed. And we've been building up over the last 15 months. We focus on high growth loans to SMEs from £1 to £20 million. We've currently increased our loan book over the last 18 months from 0 to just over £600 million.
Hi, good morning. My name's Alston Zecker. I work for a VC fund called 8 Roads. 8 Roads is a global VC with teams in London, Mumbai, Shanghai, Tokyo, and Boston. We have about $3.6 billion of assets under management, and FinTech is one of the 4 or 5 sectors in which we focus. We do enterprise technology, we do healthcare, and we do consumer technology as well. Some of our portfolio companies include Compte-Nickel. We've invested in Alibaba, and we are therefore involved with the Alipay project as well. In the States, we've invested in a number of insurtech companies, payments companies, and the like. And FinTech's an area that we're quite excited about, obviously. Prior to joining 8 Roads, I was one of the co-founders of a mobile point-of-sale business called Pay11, and I was COO of that business for 3 years before coming over to the investment side.
Hi, my name is John Doran. I'm a general partner at TCB. We're a growth equity firm, so think of us as kind of the later stage of the VC cycle. And we are founded about 22 years ago in the Valley. We've opened an office in New York about 10 years ago, and in London 5 years ago. We manage about $12.5 billion, and we focus exclusively on internet software and fintech. And since 2002, we've probably made about 30 investments in the broader fintech space.
My name is Toby Treble. I'm the CEO Europe at Wealthsimple, which is one of the fastest growing online wealth managers, founded in Canada 3 years ago, where we have now more than 40,000 clients across $1 billion in assets. We expanded to the US earlier this year and to the UK this morning. So we're live in the UK as of today. We're backed by a strategic partner, Power Financial, which is a large financial services conglomerate in North America with $1.4 trillion in assets under management. And prior to Wealthsimple, I founded an online lending business that operates that provides short-term loans to SMEs called SpotCap, where we raised money from an incubator, raised money from a VC, and also some venture debt. So hopefully can add to that discussion today, having seen various investors over the last 3-4 years.
Yes, I'm still.
Hi everyone, I'm Anthony Crawford. I work at Visa and I look after our venture activity in Europe. We're fairly new to the game, looking at how Visa can put corporate venture to work in growth stage. So how can we partner with startups and fintechs to help grow our business? Very much on growing issuance, growing acceptance, making payments more secure and fit for purpose in the kind of modern digital economy. Been at Visa kind of 6 years or so, worked from plugging in hard drives to where I am today.
Thank you for that overview. Toby, I wonder if we could start perhaps with a question for you, just picking up on your previous experience of your prior company. It sounds like you raised every sort of capital that you would expect to raise at that stage of company: incubator money, VC money, venture debt. Could you perhaps give us an insight as to which one of those you found easiest or most helpful at that stage to raise?
I mean, it depends. I think the easiest one is incubator money, but that comes with a lot of challenges and disadvantages. So, and I think that's maybe less relevant for today's discussion. More interesting, I think, VC versus sort of equity versus debt. That depends on your goals, the stage of where you are in your business, and ultimately your business model. In my old company, we raised venture debt essentially to kickstart our balance sheet lending activities, which was very quick and easy to do. However, it came with a lot of restrictions. Flexibility is one word that I think is important to bear in mind for anyone who would like to raise venture debt. It does come with a lot of restrictions and covenants attached. Sort of VC money is great, but it depends on the VC. I think it definitely helps to pick the VC wisely, those that have experience, and those that do bring a ton of experience to the table and way more than capital. And most recently at Wealthsimple, we've raised 100 million from Power, so more strategic investor that can go even one step further than providing capital, providing the experience, provides the connections, but it can also sort of grow with you to define new areas and define new strategy initiatives that you would like to go into and explore. So to answer your question in one sense, it really depends. It depends on the business, the model, the vision, as well as the stage of where you are in your company.
On the incubator funding, did you find that was a useful source of funds, or was it more about giving you some credibility in the marketplace at an early stage in your life cycle?
I think it's for, in my particular case, it's for those that want to raise money very, very quickly and not being too worried about dilution early on. It's definitely, as a founder, that's one of the downsides. But it gives you access to, if it's a credible incubator, to a whole bunch of investors that you would never ever have access to that early on. We raised 30 million euros at SpotCap with a 15-page PowerPoint presentation. That would have not been possible if it hadn't been for that incubator.
And Austin, how did you find it when you were on the company side, raising money rather than on the other side of the table? How did you go about choosing the investors that backed you?
I suppose I should be candid. One of the times we raised funding, we had the luxury of being rather picky, and another time not so much. But I guess one can compare and contrast, therefore. I certainly would agree with Toby. It was a much more pleasant journey engaging with sources of capital who actually understood, and I don't want to sound too touchy-feely, but actually cared about what we did, had an understanding of where we were going, and that natural alignment then became a very valuable relationship that carried on through the next funding round, and indeed I'm still in touch with those investors today. The analogy with dating or a marriage is actually apt, even if it does come across as a bit facile. So I would really echo what Toby says. That said, it all depends on where the stage of your business is and what your requirement is. I have met some businesses where, quite candidly, it's been a repeat founder who really knows, the team is a repeat founding team. They know what they want. They know what they're up to. They just want to get on with it. Frankly, even their Rolodex was thicker than our firm's. So at that point in time, it made sense for them to raise the highest valuation with the easiest terms. I would say they probably sit in the 1 or 2% of all situations where I meet. And therefore, I suppose, to echo what Toby said, I think being really, really thoughtful about where you are, what your fundraising strategy is, where you want to get to, not just for that current round, but the round after and the round after. It's an essential part of your strategy as a company that's looking to grow. And I feel that not enough companies are thoughtful enough about that. It's certainly, I don't think we were at my own startup, unfortunately.
And did you only take venture capital money, or did you take a range of financing sources?
We did take a little bit of venture debt as well, but that was very easy for us to repay. So I suppose that was, frankly, cheap capital, and it worked for that point in time. We did also have some funding from an incubator right at the start, and I think that it was something that we needed to get kick-started. I suppose if we could do it again, we probably would have been a bit more demanding of the terms from the incubator, and such the nature of the trade-offs one has to make.
And in terms of how you, so at later stages when you were both selling, how did you find the fact that your balance sheet or your equity line was mixed between venture debt, early stage money, investors that perhaps made sense when you were at the incubator stage, but you perhaps had less connection with by the time you exited. Did that cause you any problems down the line because you had taken that funding in that form at the early stage?
Yes, a lot. I think that's the biggest lesson learned. One of the big two lessons learned is make sure that there are not that many conflicts amongst your investor base. It's much easier said than done, but we found ourselves, and especially when it came to sort of raising debt at various terms that did want some security over the equity as well. Conflicts of interest have been a big problem, and certainly in my old company have been one of the core points that prevented us from raising a lot more money much more quickly. And dealing with conflicting interests when it comes to strategy, when it comes to vision, when it comes to what the right capital structure should be, even what the right terms are, what the right terms in that shareholder agreement should be, is a huge problem. And that's something that is the biggest lesson learned for me, that investor interests need to be aligned, and you need to pick your investors carefully.
Just moving on to maybe venture debt, do you think it's true to say that you are demanding more onerous terms from people, that are restricting their businesses as you're lending to them?
I mean, we'd like to think that we are the solution. I mean, you take an example where somebody has conflicting shareholder views. I mean, that's the point at which we can come in and provide debt to potentially take out one shareholder, leave other shareholders in. We've also, we're happy to look at dividends out and allow an investor to take an earlier stage. Our own investors found in the early stages of their business, they started to get to the point where they were very successful, and then they realised that all their capital was tied up in the business, and suddenly they felt they couldn't breathe. And so they called the dividend oxygen. It allowed them to take some of their money off the table, and so they weren't taking such conservative decisions. They could relax a little bit, step back, and start making risk decisions that previously they started to shy away from because they feared losing it all. So offering one founder an earlier exit than another founder is a very common situation, and we're lending. So we like to think that we're bringing flexibility when it's got to the stage where it is. You can see that success is clearly there, but people start to have different views about where they want to take the business or in terms of their own investment aspirations.
And just in terms of how you look at the venture debt profile, you talk about when success is clear it's going to happen. What sort of metrics are you taking into account in a contrast to, say, conventional bank debt, that obviously another option?
Well, we do both. So our earlier stage product is a $500,000 to $2 million loan product in conjunction with the British Business Bank, and that is very much looking at a stage where all the heavy lifting has been done by the equity, but you can now see that either in terms of a customer base, in terms of longevity of orders and contracts and the technology that's been developed, you can see that all that is now in place. A traditional bank might be looking at it saying, well, I just literally want to see 3 years worth of profits, otherwise I'm not interested. We're in a position to take a slightly more entrepreneurial look at it and get involved at an earlier stage.
John, I was wondering, when you look at companies that have venture debt on their balance sheet, while you probably can understand why they've got earlier stage VC money in there, do you think it's a good thing when you're seeing the venture debt in there, that it's almost proof that the business has got customers generating revenue, or are you agnostic whether it's got the venture debt doesn't sort of put you off investing at a later stage?
Yeah, I think it's a good question. I think if the venture debt serves a purpose, it kind of echo what Toby was saying earlier, it depends. If it's for growth-oriented purposes, I think it's a great idea, potentially. If it's for to plug a funding gap, I'm not sure it makes sense. Yeah. Going back to kind of some of the things that were said, I do think when you have multiple sources of capital coming into a company, you typically will have alignment issues, right? And so in addition to what you said earlier about not wanting to be diluted, I mean, my preference is always to have as little capital in the business as possible, because it essentially means the company's been capital efficient, right, to this point. But also you have to be kind of cognizant of the fact that incubators and early VCs will have different agendas, as will late-stage guys like myself. I see Colm over here from Relex, I think is a classic example of a guy who was unbelievably efficient with capital early on and probably had one of the better outcomes you'll see from an entrepreneur because he was kind of the master of his own destiny. And so I'm not saying that's the right path, but I think there's multiple paths that you can take, and it's really depending on what type of business you have. Certain businesses, like your business, for example, sounds like having a large balance sheet is very, very important. Also with Oak North, but there's other businesses like Relex where I think you can be very, very efficient with your capital early on, and that's in many ways for us an ideal situation.
And when you're coming to it later, in terms of that sort of size of check that you're looking to write, how often do you find sort of founders come to you basically asking for money? They're trying to cash up the business, not be so capital efficient. They're just trying to make sure they've got enough money in the tank to keep the business going. At what point does that sort of inhibit your conversations? Because you've got a minimum check size, they've got ambitions, but you're thinking it's a bit too early for you to
I think the way we look at it, almost always the capital that we use, and we will do some majority positions, right? We are, just to let people know, our minimum is kind of 40, 50 million investment, and we go up to kind of 250, 300, right? So it's really late stage, and we'll do tech buyouts to an extent. But for the kind of stage you're talking about, I think what we try to do is most of the capital that we'll invest will be a combination between primary and secondary. And so understanding with that primary how it's being used is kind of the point you mentioned around capital efficiency. But also we're very aware to the fact that certain founders may want to leave, or certain may not have a role going forward. If there's 2 or 3 founders, sometimes it's one guy, or one founder has all his wealth or her wealth in a business and wants to diversify that. So almost always there's a combination of the two, and that's how we kind of try to solve around the check size. And the check size thing really it comes down to the fact that because we have such a relatively large fund, right? Each fund is roughly $2.5 billion. We want to have about 20 investments in a fund, and so in that sense, we want to be able to give enough time and resources to each investment. And so a $5 million investment in a fund of $2.5 billion just doesn't make sense, right? So that's kind of the reasoning behind it.
Yeah. And Anthony, I think we're seeing an increasing trend, certainly in the investments we're working on, with corporate venturing as opposed to either late-stage money, venture capital, or venture debt. How do you think your approach as a strategic investor in that sense differs from the sort of offer that comes with VC money or later-stage debt or equity funding?
Yeah, so all money's green, right? You can get quite a lot of capital. There's quite a lot available right now. So for us, we're not directly for profit. Our CFO wants us to spend the money wisely. I can't just burn it all in a pile on the floor. But what's the extra value you get from working with Visa, right? So our investment thesis is about us being a growth stage. We can help you go from being a national product to a global platform. We can connect you up to that network, and that's really where corporates are trying to put their value in. We have networks, we have existing customer bases. So if it's a channel partnership with equity as part of that sealing the deal, there's various elements like that. So for us, it's nearly always a case of we'll make an investment alongside some kind of operating agreement, be it a channel partnership, be it us being a supplier to you, and helping us grow our business alongside yours, and the equity helps.
Which of those do you find leads the decision-making process? We often have found corporate venturing particularly leading on the strategic side, and the equity is almost to seal the commercial deal. Is that the approach you take, or are you looking more on the equity investment?
So we've done both ways. I think where sometimes equity can misalign, right? So if you have an operating agreement and all of a sudden you put equity in as a way of just winning the deal because we've got a big competitor. Sometimes we put equity in, and that then puts us with a false incentive where, because of our equity commitment, we want to make sure that grows, and we maybe over support a supplier when we shouldn't do. So my preference is to go finding the best companies who are doing interesting things which are positive to Visa first, and then looking at what the right commercial outcome is in that. I think equity first is always slightly easier, but then you have the false incentive that because you've spent the money, you have to put good money after bad to try and continue to work with this company and commit resources to it. I think it's much better for us to take it slowly, build the relationship, and then find the right agreement and the right equity position to match that. And a lot of the times that means we'll say no to equity. And we'll actually say we started this from a venture point of view. We did the engagement with you as a FinTech because that's our responsibility. But actually the right responsible outcome for Visa in this case is to have a straight up and down commercial agreement where we work closely together and we're committed to the right outcomes, but equity is not on the table.
Alison, does it put you off if you see a corporate venture fund in a company in terms of your investment?
Depends on the terms, and sometimes that means it actually depends on the corporate venture entity. But I mean, it's about the terms. I think this notion of corporate venturing has, in some organizations, existed since the 90s. And some of those organizations, we would readily welcome a co-investment with them. There are some other organizations where, candidly, it's a little bit the flavor du jour, and they're still figuring out what they're going to do. And I hear of stories within their own teams and with corporate about conflicts of how the decision's made, lack of clarity about what the KPIs for success internally, before that even then applies to what's required of the business. So you do hear on the grapevine about some of those organizations, but like I said, I'd emphasize it depends on the terms. So we would always come in with an open mind, but we'd be healthily skeptical in some situations and very, very happy in others.
And are there any particular terms, for the benefit of anyone in the audience who's talking to sort of VCs and corporate venturing, that you think would put you off as a VC investor if people are taking corporate venture money?
Well, I mean, I think as any equity investor, we just want to see the overall equity value creation of that business. We would just want to see that business thrive. So therefore, anything that might curtail the long-term strategic opportunities for that business starts to become less exciting for us, such that, for example, if together with the investment from the corporate venture firm, that rules out doing business or taking investment from other strategic players, that obviously isn't a great thing. But that can actually extend also to the way that the interests of the other investor are represented. Quite often people take board seats or take observer seats, and we would much rather there be some nature of arm's length between who's putting in the money and who's engaging with the business, trying to see that thrives, versus who's representing the corporate goals or the corporate that sits behind it. Sometimes those waters can get a little bit muddied, and you have someone who's from the line who's clearly therefore not thinking about purely the interests of the business. And of course they've got directors' responsibilities, so I'm sure they will behave in exactly the right way they should while they're in the position as a board member, but nonetheless that muddies the waters. That muddies the incentives, that muddies the mindset. So I mean, there's a whole range of things, from the blatantly obvious, like curtailing what the business can do, but also to the more nuanced things, such as who's actually involved with the business in the day-to-day or the month-to-month.
And sorry, unfairly, Anthony, how do you go about mitigating some of those challenges that no doubt companies put to you as you're looking to invest?
Yeah, so for us, we typically don't try and take board director seats because of fiduciary responsibility is a bit of a conflict for us. We do try and do board observers because we think we want to be part of that conversation. And then it's a case of we normally would put the board observer from someone within the venture group would be observing, but actually with that operating agreement or commercial agreement, we have teams who dedicate to that partnerships group. So from a business development group, people who work with that client and that partner to grow their business. So with the Square investment, we have globally now a team of like 6 or 7 people who work with Square full time to try and make sure that they're as successful as possible with Visa, and they're the advocates for Square's business internally. And obviously those two groups are in communication, probably not in conflict, hopefully, most of the time, healthy argument. But otherwise, that's kind of how we try and split it out and keep it clean.
Toby, if you were sort of starting again, leaving your current successful business and beginning again, would you go back through the same route, incubator, VC money, some venture debt, or would you start with a different approach than you took previously?
I would probably not go back for incubator money, but I would be open to VC strategic money for sure. Ultimately, it depends on the partner. I think a VC can almost be as good as a strategic partner. However, a strategic partner can probably be the worst one if just providing capital. So it really depends. And there's no clear defined answer. One thing that has been very helpful for anyone who is sort of at that stage of raising money, and one big lesson learned for me personally has been to have an in-house lawyer, which may be a little controversial, and it's often the last thing that founders or small companies think about, but ultimately it allows you to act much faster. It allows you to come across way more professional in front of investors, and ultimately you'll save legal fees. Simon, I know it's a little controversial, and we still work with external law firms, but it's definitely been a big lesson, and I would definitely repeat that. And using that in-house knowledge to identify what works, because often it also boils down to the terms, and it's not necessarily the founder's expertise to negotiate terms that may seem good and well at the time, but may impede you from or restrict you from growing further in a year or two from then.
I mean, I think one of the in-house law is actually, it's a good one, because we often find the same as an external legal provider, is we're doing a lot of education and explanation, which is fine, but sometimes we're being asked questions which it's really for the founder team to decide on a commercial basis, and we can be part of that process, but the team need to kind of understand what they're also signing up to, rather than just outsourcing the views and the advice to the external lawyers, which fine to comment, but it's actually for the founders sometimes to take their view. So I think that is a good thing, and being sort of organised and prepared is something we found is a better way of making sure you're getting the right investors and the right impressing the investors as you're putting your pitch together. Do you think there's anything, John, you'd recommend that entrepreneurs or early stage companies have done when they've come to you? There's a sort of massive no-no on raising money that just no one should sign up to because they're going to put you off later down the track.
Yeah, I think there's a couple of things. So first off, I completely agree with you, actually. When you take money early, the earlier you take it, the more dilution you're going to get. That's a fact. There's no way around it, right, mathematically speaking. So I think the longer you can hold out, and I come back to this capital efficiency, the better, in my view. That's not universal, I guess. There's probably some exceptions, but for the most part, I would say that. The thing I think that is the challenge is there's a lot of capital out there. People have said it already on the panel from lots of different sources, and with cheap capital, money that flows, you end up having. Sometimes it can be hard to remain disciplined around running a business, and we've seen it where we've given companies too much money, they've burned through tons of it, and they're like, oh, we don't have a huge amount left, let's focus on the business. That's not a great place to be. But what I would say is if you, as you're raising multiple rounds, and that is kind of feels like that's kind of the strategy today from a lot of FinTech companies, that they have multiple stages. I think it's very important to make sure that you really focus on alignment across each round. So let me give you an example. If you're doing a Series F raise, God forbid, and you have, the Series B has a 2x lick pref, and the Series D has a 3x lick pref with an 8% coupon accruing, it just becomes a total minefield for late stage guys like us. And so the alternative is we just clear everything out, and you say, look, let's just try and restart, because we really want to get alignment with a CEO. That's not necessarily easy, because the reason why these lick prefs are in there is because those earlier investors invested at what potentially were irrational prices, and they're looking for a return through structuring. It's not something that I think we do very often, but we see it a lot, and I would caution against that. And then the last thing I would just say is I sometimes get nervous when I see a CEO founder who owns sub 5% of his company. Mm-hmm. That just kind of raises questions like, how do we get here? Not always. I mean, I happen to be in one situation where I do have that set up, but I think it's a poor reflection potentially of kind of how you've used your capital, or potentially taking capital at very erroneous terms early on, and being inefficient with it.
How do you think founders can guard against that? Because we often see that when people come along with varying multiples, rich terms, everything, lots of advice from everyone. It's obviously quite overwhelming while you're also still trying to run your early stage business. What is a good port of call to try and help get through the valuations that are being offered? So
I don't have a kind of magic bullet. I'd say a few things that I would mention are mostly common sense, right? So every time you raise money, you should think about it, I think, as being the last, right? And so if that's the case, I think you'll be more cautious about how you spend it. For example, see this all the time. Companies raise 5, 10, 15 million, and they move into nice fancy premises. I can remember I met Colin multiple times 5 years ago, and you had a huge outcome, but I can tell you his premises were not fancy. He was very focused on being in control of his own destiny. That's one example. Other examples I would say are kind of growth at all costs is something that we saw probably 2-3 years ago, especially in the consumer side of FinTech. You see it less so on the B2B side. That can be a real problem, because if you're paying, and I think there's certain geographies you see it more. You see it a lot in Berlin, for example. But you see these companies that are spending $1.50 for $1 of earnings or $1 of revenue with no recurring business. It just doesn't work, right? So you're growing 150%, but the cost of that financing, the cost of that growth is unsustainable. So I would say sustainable growth, and really focusing on that, it would be something else. So kind of common sense things, but they're the things I'd caution against.
We're obviously talking specifically about FinTech today and scaling FinTechs. I mean, is there something or anything that affects your approach when you're looking at the lending to FinTechs that is different from other types of fast-growing businesses?
Yeah, I mean, I think we're in the FinTech space ourselves, so we have a clear view of where we think we're going, and we're using artificial intelligence to help us make better credit decisions. Having said that, we also invite the customers into our credit committee so that they can meet the decision makers. So we're trying to combine technology and relationship. I think for technology, obviously, for FinTech, one additional aspect you have is the regulatory side, which I think a lot of people have not necessarily thought about in enough detail. The regulatory space is changing rapidly. You've got things like the data protection. The traditional bank regulation is moving down into the finance side and other platform areas. And so I think for us, it's about making sure that the business has thought about all aspects of the future and how they can really benefit from us, and I think that the really best opportunities are those that are actually set up to benefit from that very unstable environment that we're operating in, both from an economic point of view and a regulatory certainty point of view. And we see some very interesting businesses in the financial reg tech side. Insurance tech was mentioned earlier. I mean, there's that arguably the insurance industry is a little bit further behind in terms of how far the regulation has penetrated, so there are opportunities to get ahead of the curve there. But yeah, I mean, it really is. One doesn't say it lightly, but it really is a potential revolution, and there's some fascinating businesses out there, and we're really happy to get involved and meet people.
And Alison, does it change your view when you're investing in FinTechs, regulated businesses, as opposed to any other type of company? Do you look at it differently?
Well, I mean, obviously it becomes quite an important factor to consider. Sometimes it can be advantageous to the business model. Regulations can be as much a defensive moat as they can be a cost of doing business. And so we obviously try very hard to make sure we've understood the implications. And then we factor that into the business model. I think, most VCs, echoing a little bit what John said, would like capital efficiency. Therefore, if you need to have regulatory capital, that can start to feel like a bit of a drain on the efficiency of the capital that's put to work. But I think increasingly, VCs like us who've been in and around the space for a while now understand those dynamics better. We might still shy away from a balance sheet that has to keep on growing just to keep the business running. But that doesn't necessarily have to be because of regulations. I suppose that's the thing that we're most put off by. Otherwise, regulatory risk or regulatory opportunity, that's just something that you want to price into the investment.
I'm supposed to have the iPad, which is supposed to tell me the questions people are asking. Before we go on to our last topic, I was wondering if anyone has any burning questions from the floor. I can try and read some out. I have a question here about views on FinTechs taking on growth now and working out revenue later, which I think was the point you were making about the $1.50 scenario, is there any advantage in sort of winning market share, getting market profile quickly in a space, especially if the regulation's moving quickly? Do you think, or is that just too risky to get involved in?
So given I made the comment, let me just say I absolutely am not saying you have to be profitable, right? From an accounting perspective, that's not what I'm saying. If you are, great. What I'm saying is you need to really understand the unit economics very, very clearly. Not fool yourself around LTV based on a very short observed data pool, right? And if you're confident that you have that, then absolutely, I think you should. There's many situations where you should drive growth, take share, and take advantage of the opportunity. So just to be clear that I wasn't saying we have to not burn capital. I'm not saying that.
And Alison, you share that view?
I certainly echo what John says. I would say this is still, at the end of the day, financial services. This isn't social media. Or online gaming. I stand to be proven wrong, and the romantic in me would love to see a massive multi-billion pound business being built where, to begin with, it was all about customer acquisition. I'm a little bit skeptical, I have to be honest, because I use financial services. I am not as emotionally invested in my financial service as I am with my social media, or I don't really play online games, but or as my son seems to be with his online games. And if I have my financial services, I don't particularly want my data being sold and my privacy being intruded upon in the way that for some reason we're happy. So I am somewhat skeptical. And so that's a personal point of view, and we have these debates constantly within my team. But therefore, to John's point, I think the unit economics need to work. I think some of the best successes we've seen in FinTech, and that is in China and in the US, most of those businesses pretty early on had a good sense of their unit economics. It might not have seemed that way from the outside, but they did have a good sense from quite early on. And I think that's really important to understand. I think one can get a bit too carried away by consumer media and conflate that with an opportunity that might exist in financial services. Like I said, love to be proven wrong. Most likely I'll be kicking myself 5-10 years from now. But I'm prepared not to take that risk, and I think most people in the investment community in Europe would be prepared not to take that risk as well.
And Toby, is that consistent with your experience? If you're trying to build a brand, launching a new business, versus the pressure from investors to show profit and revenue generation from your customers?
Absolutely. I think it is one of the most important things to show a path to profitability that is reachable and that makes sense. Unit economics versus John's point on LTV calculations that will never make sense is probably not the best starting point. The one thing I will add is in the fintech space, I think it's probably clients can be sticky. And we've seen in Canada our churn rates over the last 3 years have been extremely low in the online wealth management space. And I think what we have to factor in is sort of cross-selling opportunities that will ultimately make your clients more profitable on a per client basis. And that's something that is very hard to factor in, but that is what strategic investors, in our case, also sort of are looking to achieve through the investment in Wealthsimple. That starts off in the wealth management space, acquires clients, but ultimately the space, there are a lot of opportunities in the financial services space, whether be it through partnership opportunities with corporates, or entering into new business areas, because ultimately people like to have one point of contact for multiple touch points across financial services.
Mm-hmm. Good. So I think one final question from me then. Does anyone think, adding to the mix, we've been talking about equity, debt, that initial coin offerings are the way to finance fintechs going forward? Open question to anyone who'd like to respond to that one.
Do I have to answer just because I work for Visa?
Looks like.
So, I mean, they're fascinating, right? There's a huge number of pros and cons on them. I think they give instant liquidity in the business, and I think that's a set of false incentives. I don't think any VC's proven that giving instant liquidity to the founder and letting them walk away on day one is a way of getting a founder to stick around and work hard. There's some challenges in that. I think they create an awesome set of new incentives for how to build a business and how to reward your customers for taking part in your network. but it has to be a very specific business where that will work for. I mean, how does anybody do an acquisition or an exit when you've already sold all your tokens on day one? Like, what happens if a Google wants to buy your company? Do they get your IP, or does it already been given away for free? Like, how do you actually exit that business and build that business?
It is creating a new class of customers for Wealthsimple, though, so, that's probably quite nice. I think, from a purely academic perspective, I think it's really fascinating because of the challenges it poses to existing regulatory environments. This is independent of jurisdictions. We still have regulators scratching their heads about, having debates about, is this an asset, is it a security, how do we map existing regulations? I'd echo what Anthony's saying there. I think it's fascinating, and I think it's an amazing experiment in greed, fear, innovation, technology, all in one go. I think it will end very sadly for certain individuals. I think it will end very well for other individuals. And I think what's really exciting about it is what we learn from these experiments, because I think no one would disagree that ICOs in their current form will, if they even exist in 2 or 3 years' time, will be vastly different from where it goes. I think, if you're great at timing markets and speculating, go for it. And if you're not, like me, sit back, enjoy the show, and hope that not too many individuals get hurt who can't afford to be hurt. And then let's see where that takes us in 2 or 3 years' time. I think the notion of crowdfunding, the notion of a decentralized autonomous organization, the notion of having your investors feel that they are more true direct stakeholders in a business, I think these are very valuable concepts. And I really think we should take those to heart, because they will do a lot for the nature of an organization going forwards. But the ICO itself, that's version 1.0 anyway.
Yep.
So let's see where we go.
And does crowdfunding have a role, do you think, in a consumer-facing fintech business in a way that perhaps it doesn't in a B2B fintech? Is there a role for brand building through that sort of crowdfunding, or is that just annoying money that it's better not to raise it at that level? What's your view on that?
Again, debates in the team. I think it's amazing marketing. I think it's been a really good way of creating that sense of mutual ownership, that emotional connection. It's doing what I said some financial services have not been able to do before. Create that emotional connection. So I think that's fine. For me as an investor, of course I worry about whether that makes the capitalization table too complicated.
Yeah.
On the flip side, actually, I'd say some of the crowdfundings I've seen have given basically no rights to a lot of the individuals. So for me as an investor, then I'm not bothered. Of course, me as a person, I do wonder whether ethically that's the greatest thing, because then these are minority shareholders in an illiquid company who have often fewer protections than even minority shareholders would in any other setup. So that's probably not great. But caveat emptor, I guess.
Yeah. I mean, we've had both. We've had clients that have both crowdfunding alongside our loan and retail bonds, and it's quite good profile, and they find it almost a bit fun in a way. It's not meant to drive their growth particularly, but I mean, both that and ICOs. I mean, there is a reputational issue. Speaking to someone in a heavily regulated business, you do get one shot at reputation, and particularly now with the social media and that. And if some of these platforms are open to abuse, then it is potentially damaging for what are interesting sources of liquidity.
Good, great. Well, I think that concludes this panel session. So join me in thanking all our panelists for their time. Thank you.